time that corporate profits as a percentage of GDP were higher than today was in 1929.
If you're right, then this is the stuff of worldwide crashes.
Yeah, no, I definitely think the big risk going forward is deflation.
This $42 trillion in private debt, kind of just like the Great Depression, that can unwind and deleverage very rapidly. And when you destroy that much debt in dollars, because debt creates dollars right out of thin air, that's what causes deflation instead of inflation.
We've essentially added more liquidity to the system. We've gone from private sector leveraging to public sector leveraging. There will be an accident to come.
Last 4 years, we expected spending to slow, but now we expect it to slow more. This means government stimulus will work even less. And you got the Fed on hold for the last 6 months anyway, because the economy's been improving. So just when the economy looks good here, we expect by the second quarter for our economy to weaken again, just like it did in 2010 after QE1. It'll weaken on an 8 to 10 month lag from the end of QE2, and we're going to be right back diving again. And I think it's going to, by the time the Fed reacts, it's going to be too late.
It is likely that the entire financial system will collapse in 1 to 4 years. It is likely that the deflationist theory is right, and there will be a collapse. However, they will be wrong in what they are doing to protect themselves. Those concerned about a currency crisis and hyperinflation will likely have their convictions shaken to the core in the very near future. We do not believe we will slip into an out-of-control hyperinflationary scenario. Instead, it will be a deflationary collapse followed by a currency crisis. However, this will be a worldwide currency crisis, so you won't be safe, even if you are heavily invested in Euro and Pacific currencies.
There is a plateau phase between 46 and 50 where the kids are getting out of the nest, either leaving high school or college for the workforce. It's when those kids are fully out of the nest from age 50 on, that people's spending dives. And I'm telling you, it goes straight down from age 50 to death. So baby boomers in the highest numbers are going to be in that decline phase starting around 2012. It's the peak of the massive baby boom generation's entire spending cycle. And for many years to come, they're going to be spending less, saving more. This is something we can predict very reliably with demographics, and that means the government stimulus is going to be limited in effect and probably not last more than next year. So people have to prepare for the next crash and downturn.
As economist Harry Dennis pointed out throughout his research, the largest generation in U.S. history has peaked in spending. This generation dwarfs the generation before it and after it. Dent's research notes that as people get married, have children, buy larger homes, and eventually see those children consume more calories as they age, individuals peak in their spending habits between the age of 46 and 50 years old. The statistics are undeniable and the logic is simple. A 30-year-old with a 1-year-old is spending more than he did in the previous year. He is buying diapers, baby formula, infant food, toys, clothes, games, and new visits to the doctor. Fast forward 16 years, that same parent is now purchasing more expensive clothing, a significant amount of food, movie tickets, cars, auto insurance, and divvying out allowances. Once that parent becomes an empty nester, their spending collapses. The contraction in spending in the U.S. makes normal price inflation unlikely. In fact, we will instead likely see a collapse in spending. And taking into account that the U.S. is a 72% consumer-driven economy, California, one of the largest economies, is an 81% consumer-driven economy, the future is bleak. To put it simply, the 1990s aren't coming back anytime soon. Many believe a repeat of the 1990s is possible with just the right government and monetary policies, but this is factually impossible. During the 1990s, a wave of baby boomers hit the economy. The first baby boomer hit 46 in 1992. The internet was introduced to the civilian population, and we had a communications revolution. We saw the dot-com bubble, and as a result, the 1990s saw over 24 million jobs created in a single decade. Currently, we have roughly 25 million people either unemployed or underemployed. That being said, we would need to repeat the 1990s in order just to absorb the current level of unemployment. This doesn't include all of the future high school and college graduates, especially the august college graduates majoring in degrees such as philosophy and surf science. Our economy runs on credit. The consumers are maxed out.
When you begin to do the arithmetic of what the rising debt level implied by the deficits tells you, and add interest costs to that ever-rising debt at ever higher interest rates, the system becomes fiscally destabilizing.
The entitlements in government mandatory spending is about to soar. Last year, D.C. came to a screeching halt in order to cut a measly $39 billion out of a $3.5 trillion budget. To put that to scale, if you made $2,200 per month and spent $3,500 per month, if you were the U.S. Congress, you just celebrated that you cut $39 out of your monthly budget in order to avoid a spending binge shutdown. To call the situation hopeless in D.C. is an understatement. Silver and gold manipulation is seen daily through the work done by the Gold Antitrust Committee, also known as GATA. We know that the large Western banks in collusion with the U.S. government and central bank suppress and manage the price of gold daily. We also know that the banks have admitted to manipulation of the LIBOR rate, not to mention the daily price fixing the Federal Reserve is involved in through the manipulation of our own interest rates. The Fed fixes the payments of mortgages, credit cards, auto loans, personal, and many other loans. This is critical when we live in a debt payment society. Soon the stock market will collapse, the volume is anemic, and the entire rally we have seen has been nothing more than a Fed money printing rally, followed by Fed rumor money printing rallies. The E-Trade baby boomers have become demoralized, and Generation Y is unemployed. There is no driver for jobs, and no driver for a continuous bull market. Even with the 401kers depositing their funds on a monthly basis, giving Wall Street traders regular buyers to sell their shit to, the game is up. The 401k experiment that started in the 1980s will fail as portfolios collapse and everyone holding their funds realizes that all the buyers of the last 3 decades are now sellers. Unfortunately, the generation behind them is smaller in size and out of work. As selling pressure mounts, equities will crash, and when they do, so will gold and silver. The need for liquidity and the sale of stock will create a demand for dollars like the world has never seen. The deflationists will celebrate in all their wisdom as after several decades of being wrong, they will be glorified as being prophets of doom. Of course, what is to follow is a massive flood into hard assets as the central banks around the world print on a global level. Or as economist Mike Krieger calls it, the big print. Between the fundamentals of the U.S. economy being in shambles and the central banks printing, the perception and confidence of the U.S. dollar will force a run on fiat currencies. Remember, the baby boomer spending is already in collapse. Tax revenues will drop dramatically just as entitlements begin to soar. During the 1990s, enrollments for Social Security averaged 500,000 annually. During this decade, that number will be closer to 1.5 million. Forget about $1 trillion deficits. It will take that just to help cover the mandatory spending. We will soon see $2 to $3 trillion deficits. And as the national debt soars past 20, 25, and $30 trillion, this type of parabolic move will unleash the fiat currency crisis the hyperinflationists have been warning us about. As governments and investors flood into gold, we will see a parabolic move in gold, silver, and hard asset stocks like gold mining companies. The fraud and the manipulation of the gold price will be revealed. As the SLV and GLD are exposed as reported scams, the day the COMEX defaults and goes into force majeure, liquid assets sitting in trading accounts will flood into the gold mining stocks. Wait a minute, gold mining stocks? Yes, as physical gold and silver become unavailable, investors will move into the next best thing. As ETFs are no longer trusted, liquid money will flow into mining. Sorry, but we just don't see someone with millions of dollars in a trading account calling up APMEX.com. We see them moving those dollars into hard assets with the click of a mouse. Ultimately, those investors who cashed up for the deflationary scenario will be holding worthless fiat currency. However, as a moral victory, they will at first be 100% right. However, in our opinion, there is nothing worse than being right about the economy and losing money. Our advice, stay current, focus on the trends, and protect yourself by being educated in Austrian economics.